Good evening, everyone. My name is Joanne Jobin. I'm the founder of the Mining Investment Event, which takes place annually in Quebec City. Before we start, I would like to thank TD for sponsoring this evening. Wonderful, generous sponsor. Also Marsh, Vid Media, and the Mercury Group for being part of this really unique evening. As you can see, this is being taped. It is not live. It's being taped for podcast purposes. But once approved, it will be available for download and sent to the hosts as well, or the sponsors. Before we get started, I'd like to say a few words about ITFA, the International Mining Week, which we announced yesterday, and also the event, or it's the Mining Investment Event, but we do call it the event. We're the only Tier 1 independently sponsored mining investment conference in Canada. It's held annually in Quebec City. The conference itself has grown 300% since we launched in 22. So we have become a bit of a going concern, which we're really pleased about, and we expect 26 to be another strong year in growth. I'm particularly excited about this year as we will be hosting ITFA on our main stage on June 1st at the Convention Center in Quebec City. They, along with the Mining Association of Quebec, which represents all of the international producers across Quebec, have joined us in founding International Mining Week. We announced this yesterday via press release. It's an amazing opportunity for groups like the AMQ and also ITFA and ourselves to sort of plant a flag in the ground and declare this the very first International Mining Week in North America. And we expect more groups to join us as well. And now I would really like to introduce our illustrious panel for this evening. Our first panelist, Mark Tiberio, Director of Mining Investment Banking at TD Securities. Mark brings over a decade of experience in mining finance and operations, including roles at CIBC World Markets and Quadra FNX Mining. He holds a degree in mining and mineral engineering from the University of British Columbia and specializes in valuation, corporate finance, and the metals sector transactions. Next joining us is Daniela Dimitrov. Daniela is the Executive Vice President of Sustainability, People and Strategy, and Corporate Development at Equinox Gold. Daniela has over 25 years of leadership experience across the mining and financial sectors, having served as CEO, CFO, and board director with several global companies. She currently sits on the boards of Nexa and Chemtrade Logistics. And she was recognized among the top 100 global inspirational women in mining. Daniela also holds an executive MBA from Kellogg Schulich and a law degree from the University of Windsor. Next, we have Ian Sperko, Associate Director with the Markets and Partnership Team for the Americas at Control Risks. Ian advises clients on operational and strategic risk across global markets with recent work in Latin America and the mining sector. He holds degrees from the University of Toronto and the London School of Economics and brings deep expertise in conflict analysis and risk management. Rounding out our panel is Gary Stanley, former director of the Office of Critical Minerals and Metals at the U.S. Department of Commerce. During his distinguished public service career, Gary led U.S. efforts to strengthen competitiveness in the global critical minerals sector, and he was a lead author of the 2019 Federal Critical Minerals Strategy. He continues to be recognized as a leading voice in U.S. minerals policy and trade. Ladies and gentlemen, your distinguished panel for this evening. Just a reminder that we will be doing Q&A after the panel session. If anyone has any questions, I would invite you to hold up your hand. Sydney will come to you with a microphone. Please identify yourself and then ask your question. Excellent. So, shall we start? And now for our questions to the panel. First question. Can you please comment on the impact that tariffs, commodity risk, price fluctuations, and other geopolitical events have on logistics, risk management, and the delivery of commodities or finished goods such as gold and cathodes worldwide? And Ian, we're going to start with you.
Okay. Well, thanks very much, Joanne. Thank you to ITFA and the Mining Investment Event and TD for hosting this discussion. Obviously, a very, very timely question. I think the key point here is that geopolitical and market volatility doesn't just change the cost of demand, and it doesn't just impact one part of a supply chain. It changes the risk profile of an entire chain, and it creates a domino effect across logistics, cost management, and risk exposure, introducing enormous pressure on both sides of the transaction. So you have producers having their margins squeezed, and traders facing disputes and increased hedging costs, logistic providers absorbing higher costs, and then the end user ultimately is left with either higher costs or waiting for product. So from a risk management perspective, I think there are three big challenges. Number one, on financial exposure from commodity and currency volatility, and that's forex swings, that's prices fluctuating in transit, that's tariff hikes and changes in port duties. These can alter the cost structure of a shipment mid-voyage, and you saw that in July with the 50% tariffs on copper that were slapped in 232. Before the clarification was issued on July 30th that it was for semi-finished products and not copper concentrate, you had ships streaming out of northern Chile trying to reach southern U.S. ports before those tariffs hit, because the delta between what would have been owed before and after on copper concentrate, somewhere in the neighborhood of $70 million for a typical bulk carrier cargo of 15,000 tons. So you can imagine quite a few sleepless nights for owners before that clarification was issued. The second challenge is logistics exposure. If routes are disrupted by sanctions, strikes, or security risks, and you can take the Houthi escalation and the Red Sea shipping crisis as an example there. What was the impact on transit time? What was the impact on freight costs and on insurance premiums and general uncertainty in delivery windows of bypassing the Red Sea and having to circle the Cape of Good Hope? All that matters, obviously, to commodity trade. And then counterparty exposure, where buyers or sellers may seek to renegotiate terms, and default risk goes up if market conditions shift abruptly. So in terms of mitigations, I think for business, the lesson is to diversify and to prepare. The reality is that volatility isn't going away. And if the last 5 years have taught us anything, it's that supply chain shocks aren't temporary; they're permanent, and they're something that we need to cope with. So, hedging and contract flexibility are critical. Escalation, de-escalation clauses in sales contracts, swaps to insulate against sudden spikes, diversified logistics planning, build redundancy into your logistic corridors so that you're not hemmed in. And then most important, maybe real-time geopolitical monitoring, because tariffs, sanctions, export controls, they don't happen in isolation. They're not just numbers on a spreadsheet. They're the product of political negotiations and trade disputes and security concerns. So anticipating those moves rather than reacting to them is how our resilient supply chain can preserve their margins ultimately.
Thank you, Ian. Daniela, do you have anything to add?
Yeah, I'll just pick up on a couple of words that you use. One is resilience, and the other one is agility. And I used to say during COVID that none of us had a playbook for it. We hadn't been through that situation before, didn't have a roadmap. And those that came out faring well were the companies and management teams that really had resilience and agility, innovated, were creative, and were able to deal with that ambiguity. That was followed by a period of really high inflation, where again, none of us had really been through those kinds of times in the last 20, 30 years. And we come back to that resilience and agility because nobody had a playbook for how to deal with, the high inflationary environment that we had been facing coming into this year. And it's really drawing back on the same capabilities on resilience and agility, because now we've got to deal with the geopolitics and its investment credits one day and its tariffs the next day. And the news cycle seems to be moving a lot faster than markets seem to be moving, and certainly than supply chains were capable of moving. So I just echoing your comments, continue to build agility, resilience into the businesses, into the decision-making process, into risk management, into the supply chain, having contingency plans, and really playing those scenarios that now involve geopolitics, to be able to not only react but have some foresight.
Thank you, Daniela. Gary, would you like to add something to that?
Absolutely. So I think for everyone in this room and those that will be seeing this at a later time, we would never say that COVID was a good thing. But I think everyone will also acknowledge that there were excruciatingly painful lessons that were learned as a result of COVID, to which I would think that everyone that's involved in these conversations today would say the lessons have to be learned and there have to be permanent changes made. Now, why do I reference that? The current crisis in which we find ourselves now was foreshadowed back in 2009, 10, and 11. And many of you will recall that was the first rare earths crisis, where as a single global supplier, one country had control of a global marketplace. And then just as quickly as those lessons were being learned, we took our eyes off the target, and we found ourselves, as soon as Beijing cranked open the spigot for more rare earths, all of a sudden our problems are resolved. And then 15 years later, where do we find ourselves? Same place we were back in 9, 10, 11. And so I think one of the most important lessons for whether it's government, whether it's for OEMs, or whether it's for those that are actually involved in supply chain analytics, is moving away from traditional business models to those which are demonstrating more resilience, more diversification, and the idea of single source supply lines is a dangerous model for everyone. And COVID exposed that to a degree I don't think most people in the space of manufacturing and processing were actually aware of just how acutely vulnerable the world supply chains were. And so one of the things I am most excited about is seeing the intentionality of governments and industry and all of those up and down the supply chain to addressing these issues long term.
Thank you, Gary. And that's a great segue for our next question, which is mitigating risk with government support. This is something that we have all seen recently. The government of both the US and Canada seems to be stepping up in terms of fast tracking projects. But is it enough? Panelists. Okay, we're going to start with you, Mark, on this one.
Sure. I mean, I think for the governments, there's been a long time here in both Canada and the US where projects have just taken too long to get off the ground. Permitting timelines are way too long. Mining is difficult enough as it is from the exploration side of things. But I think right now, if you're looking in Canada and the US, it's about 20 years to get a project online from first exploration. We've got to move that timeline up, specifically for critical minerals and commodities that we need to diversify our supply chain and make sure we have domestic sources of supply. So I think the government could provide a lot of support just on the permitting front. We've seen some of that starting to happen, but also on the critical minerals side, whether it's rare earths or whether it's lithium or other commodities, graphite is a good example. They've got to support these projects because China right now is just dumping material into the markets. These projects, a lot of them aren't economic on their own without government support. But we've got to do it today. I think, Gary talked about the lessons that we should have learned from 15 years ago. This time we've got to actually execute on the playbook. Because whether it's energy transition or battery metals, what have you, if we don't get these projects online, if China does ever turn off the taps, we're going to be in deep trouble here.
Thank you, Mark. Daniela, thoughts?
Yeah, as Mark said, we need projects permitted, built, and operating within a decade, and not generations. One project, one review really makes a project investable and makes our jurisdiction investable at the end of the day, because capital prices, not only prices that risk in, but capital is not attracted where you don't have that certainty and that visibility as to when will you get to the end of a process. We have seen in the US the FAST-41 permitting process, and we have actually seen projects now gone through that process and be at the end of the process and be permitted. In Canada, the new federal government has established a major projects office that was announced in the summertime. This new regulatory body, new administrative body, the mandate of it is to really break down silos and bring stakeholders together and really accelerate the permitting process for projects that have been designated as major projects in Canada. So it's not for every mining project, it's for designated projects, and there are some pretty interesting criteria, I'm going to say, that has been released around what will or what could be a major project that could fall within the mandate of this office, where we might see that acceleration. I think the other thing that we've seen in the US, and we were talking about this, Mark and I, ahead of the session, is capital. And we've seen the US not just accelerate permitting, but make equity investments now in Canadian companies with projects in the US, and recent announcements in terms of investments in Lithium Americas and Trilogy. That is a copper project in Alaska. So that's the other support, I guess, that we've seen south of the border, which we hopefully might see more than the form of a few $1 million here and there to move some projects along, because that's not going to break the back of it.
And I mean, are we always waiting for the government to fast track projects? I mean, what can the sector do itself in the meantime? Gary, what do you think?
The success in this space has to be the intentionality of both public as well as private stakeholders. And that means up and down all levels of government, as well as all levels of processing. And so one of the things that I think industry, as the true subject matter experts, I spent 41 years with the government, and I always refuse to allow myself to be called a subject matter expert. Why? Because it's the people that are actually doing the work that are the experts. They know the competitiveness issues, and they know the issues. They know the solutions. Government can facilitate many solutions, but really it is the role of the private sector to actually make the case, to demonstrate the need for future success in any of these projects. And quite honestly, I think coming from the private sector to the government with solid concrete projects, and I learned this years ago, whether it was working with the Defense Production Act office at DOE or the MESC office at DOE or whatever it might be, a good project is a good project. And if it's sound, if it's solid, it has good economics, has good foundations, it is a project that will sell itself. But it is really incumbent upon the industry to be responsive to policy guidance that the government sets, again, at the federal level, at the provincial, the state government level, whatever it might be, to actually demonstrate where those priorities are, and then for the private sector to step in and demonstrate a competitiveness factor that says these projects are legitimate.
Well said. Ian, do you have anything to add?
Yeah, I mean, not much to add there. Obviously, there's strong funding and strategic support for critical minerals and energy transition projects, and on both sides of the border, as Daniel and Mark alluded to. I'd only add that there's a risk of announcements outpacing developments and implementation in that space. And there's a real world consequence there, and just in terms of sapping project momentum and spooking financiers ultimately. And then in terms of sort of what to do in the in-between while you're waiting for permitting or funds or project changes, reduce your non-policy risk. So make sure that your project is first in line when those approvals do come through, and that it's really a box-ticking exercise at that point and nothing substantive. Tighten your permitting paperwork, design your projects in phases, and increase scenario planning so that you can sort of get ahead of the government, as it were.
Excellent. All right. The next question is kind of a loaded question. So, panelists, what is the biggest political risk for Canada and the USA? And do not say the government. I know, Danielle. You're looking at me going, you know what I'm going to say. All right. We're going to start with you, Dee Dee. Go ahead.
I'll keep it short. In Canada, I think it's execution. So we've seen a lot of announcements over through the summer and into the fall around major projects office, cutting down permitting timelines, bringing down interprovincial barriers, allowing talent to move between provinces, maybe even for us here in Ontario, being able to buy wine from BC. And so it's really execution to match all of these announcements that have been made. And I would say in the US is the risk is just lack of predictability. And we've seen we've seen announcements that, as I think I mentioned in my earlier comments, that go from investment credits one day to tariffs the next. And capital, particularly in mining and in the energy sector, where you have such a long investment time horizons, where you're investing significant capital up front, and you could have 10 years, 20 years before you generate $1 of revenue. That kind of capital needs predictability and stability, and so I think that's the biggest risk for the U.S.
Gary, since this was a Canada-US question, I think
Sure.
you're well placed to answer.
Well, I'm happy to avoid anything as it relates to Canada. My experts on the panel speak, but from the U.S. side, and again, having been a part of both the Trump first administration and the Biden administration, the things that clearly stood out was, first of all, there's no way to avoid the topics of global trade protectionism. Whether it's a export quota or it's tariffs or whatever it might be. But as I've said to many people, is the reminder that tariffs is a tool, it is not a policy. And again, full disclosure, I was a born and raised convicted fool on fair and free trade around the world. So I am a fair trader. But I also understand the nature of the president's use of tariffs as a negotiating tool. That's why I said it's a tool, it is not a policy. I would also say that beyond just the trade protectionism, and that includes the Chinese, using export quotas and export restrictions, violating, and it knows it's violating its WTO obligations. The one thing that the Biden administration and the Obama administration before that did was to use the WTO as a battering ram against the Chinese. There were 3 successful WTO cases against the Chinese on critical minerals. Folks aren't even aware of that. The problem with the WTO, as it is in a lot of government entities, is it takes years. It took 5 years. 5 years to negotiate each one of those 3 WTO cases. How much changes in 5 years? Actually, what changes in 5 months? Like 5 years just takes too long. But I would say global protectionism. I think the second thing, and I think we have to be honest about this, is the ongoing global, regional, bilateral conflicts. Just what's taking place in Russia and Ukraine continues to disrupt global critical minerals markets in a number of areas. And it may seem insignificant comparatively, but what's going on in the Middle East? What does that impact? It impacts investment, future decisions, and even getting companies to be willing to go into those regions to look at possibilities. The third thing is, for the United States especially, is the U.S.-China trade relation. Like, it's just simply too big of an issue that has generational potential impacts that cannot be minimized whatsoever. There's a reason why during his first term, and I think during this term, will continue as a strong emphasis by the Trump administration to deal with the balance, with not only the balance of trade issue, but really dealing with this single source supply for too many areas. And then lastly, I think it is that idea where you just simply have a global monopoly that China has in this space that has to be addressed. There is no way that can possibly be understated, the potential effect that that has. Just today's announcement, right? You guys, many people in this room probably heard, in preparation for Trump going to Beijing possibly later this year, the Chinese make an announcement that they're going to further their export restrictions on rare earths. That's the kind of political risk that cannot be underestimated in terms of its impact.
Thank you, Gary. We're going to move on to the biggest news items in the sector. The Teck Anglo deal. What does this mean for Canada and our global positioning with commodities? Is this just another foreign investment that we are losing our resources and our companies to? Mark, I'm going to let you kick this one off.
Sure. I mean, obviously, that deal, the way it was structured with keeping the head office in Vancouver, I don't think that thing gets done any other way. Even with that, there's a lot of questions coming out of the ICA and from the federal and provincial government in BC, whether that's enough. There's obviously a lot of chatter about interlopers coming in and someone coming in over the top, whether BHP or Rio Glencore. Glencore obviously made a run at Teck a couple of years ago and then ended up buying the coal assets off of them. But I think for all of them, they're going to struggle to relocate their head office. So that was something that Anglo was able to offer up. You know, over the last 20 years, we've lost a lot of the national champions in Canada on the mining side, going back to Inco and Falconbridge, and more recently, Goldcorp. So I think it's going to take a long time to review. I mean, they've said 12 to 18 months. I'd probably take the long end of that, them to figure it out. Anglo's been very clear that they're not going to change their domicile. I think there'd be a lot of tax consequences there. But I think it's key that we make sure that they're still in Vancouver and that they're in Canada. A lot of the executive management, I think, is going to be splitting time between Vancouver and Toronto. But it's great. I mean, I spent a long time in my career in Vancouver, and the loss of Goldcorp there hit the city hard, not just from an employment standpoint, but when you think about all that the mining does for sponsorships and for charity and things like that. So I think it's key that we keep them here, and it's going to be a long review to make sure that, you know, what they're promising is actually lasting. You know, when Newmont bought Goldcorp, they kept the Vancouver office for like a year, and then switched out. It used to be Newmont Goldcorp, and then they dropped the Goldcorp, right? So I think the lessons learned from that, I think the Canadian government's going to take a long time to review it and just make sure that what Anglo is saying they're committed to.
Okay. And Daniela, your thoughts?
I guess I'm of two minds on this. So all the low-hanging fruit is gone is what we say about mineral deposits, and that the ones that are close to infrastructure are not north of the Arctic Circle or somewhere in the Amazon jungle have been found, developed, and probably mined out. And so we're seeing, not just infrastructure challenge, but overall lower grades. So we need companies that have access to a lot of capital in order to develop the projects that are now available. And we've seen, obviously, Teck develop QB2, not without its challenges. And so if it wasn't for the Anglo-Teck merger, we may seen another company actually take a run at Teck, as Glencore, I think, sort of did. And then we've seen, we see the likes of Rio, BHP, Freeport, Vale, that are much larger companies, have more access to capital, have a lower cost of capital, have greater liquidity, and so on. And so how can, on one hand, I understand the protectionism, but at the same time, we've got to have companies that ultimately are competitive and can compete on that global stage with the likes of Rio, BHP, Vale, et cetera. And so we can only do that for so long because then it just doesn't work. So I really think about how do we create that environment in Canada? How do we continue to, we're back on the permitting, access to capital, talent, and resources in order to, again, build companies that can grow into a mining giant, but don't, necessarily, not that Teck stumbled, but grow our own mining giant. And
Right.
I don't know how long that office is going to stay in Vancouver. I'm probably maybe thinking that maybe not that long either.
It'll just be a shell office.
But I think about creating companies that can compete.
Okay, thank you. All right, the next question, I'm really excited about this question because everybody's seen this happening. New money into the sector, yay! Particularly, I'm going to call them respectfully, the tech bros have entered the chat. And, I hear from certain sources that there's another potentially 30 billion to deploy into the sector. So I'm going to lead off with you, Mark. What do you think?
Yeah, I mean, I think Tether has bought about like $10 billion of gold right now. They've put $100 million into Elemental Altius, which is a royalty company. I was down at Beaver Creek a month ago, and the Tether CEO was there, which is probably the closest I've ever been to a billionaire, which was kind of cool. But I mean, it's creating a lot of buzz. It's obviously huge amounts of capital that could go in, whether it's into the commodity itself or whether it's going into these companies. Mining uses up a lot of capital, as Daniela was saying, so we need all the money we could get. So it's great to help support these guys. But more broadly, there's also government money coming in, as we talked about earlier. The U.S. government, there's been talk that they're going to partner with Orion to fund critical minerals investment. That's $5 billion is the number there. CGF has a $15 billion fund in Canada that they've already deployed some, but there's a lot of money to go. And then just, depending on the commodity in the gold space, their developers are raising, there's about $1 billion a quarter right now of equity being issued. So new money coming into the sector from more of the public markets. That's something we haven't seen in a very long time. And if you look and you ask Daniela, there's not a lot of quality gold projects out there because for the last, 5+ years, there just hasn't been the exploration dollars going into the ground. So we haven't seen a lot of new projects. The same is true in copper and stuff like that. So all of that flood of liquidity that's coming in is going to go fund these Explorcos, because that's the grassroots to go and find these projects, advance these projects through studies, and then groups like Daniela could go and scoop them up and actually go and build them.
But we also hear that, the money is finally entering the Explorco territory because a lot of the big seniors are cashed up. So that money is slowly starting to trickle into the Explorcos, who really need it as well. And Daniela, what are your thoughts on the new
Are the
money?
generalists coming? Are
Yeah.
they coming?
The generalists are always
They're
coming,
coming.
Daniela.
They're always coming. They've been coming for like 5 years
they're,
now.
They're always
Coming.
coming, but they've never
It's a
actually
myth.
arrived.
Oh,
That's
my
the problem.
It's a myth.
I guess I'll speak from the industry perspective, because I've seen a lot in the last couple of years, various publications from the banks explaining, mining 101. I love the one on return on invested capital of the industry. So coming up with metrics other than ounces, where you can attract other capital that's not used to, I guess, the mining industry metrics. And when you look at those other metrics like ROIC versus other investments, because we're competing for capital, we're competing for shelf space, we're competing for attention. And when you look at those other metrics, we don't fare so well, particularly over a 5-10 year time horizon with other industries where you can get a much better ROIC. And so I think as an industry, we have to remain disciplined. And I know gold is at $4,000. But we have to make sure that we stay good stewards of capital. And I think our industry, I don't want to sound critical, but we have destroyed value in the past. So being disciplined about our investments, making sure that we build on time, on budget, making sure we are, again, good stewards of capital, we allocate capital properly, we generate a return on invested capital, and we return capital to investors. We've got to just continue to stay focused in order for that capital to come in and for it to stay in.
Thank you, Daniela. All right, let's talk about commodities pricing. We have all seen gold and silver skyrocket. I mean, gold smashed through 4,000 this week. So, I mean, that's pretty exciting. I remember when it was $250 an ounce. We're not going to talk about how I started this industry when I was 12. So that says a lot. Lots of predictions out there. Let's ask the panel what their thoughts are in terms of separate commodities. Let's start with gold and silver first, and then we can move on to critical metals, REEs, and the geopolitical supply chain affecting these prices. So, Mark, you're the commodities expert, so we'll start with you first.
Oh, I forgot my crystal ball downstairs in my office, unfortunately. I mean, gold's been on an incredible run. I can tell you what our TD Commodities desk thinks is that we're a bit overbought right now, but I think they've got it going to 4,600 by the back half of next year. I think with the weakening of the US dollar, you're seeing a huge inflow into gold, back to the tether point. That's why they're looking to deploy money into gold. So I think the market is set up very positively for gold. On silver, silver has gone through some pretty wild cycles before. I think silver, there's more of an industrial use for silver as well, and there's really been a short squeeze that's been going on for a while there. But that one could continue to move. If you look at the historic ratios between gold and silver, silver could easily move up to $100 an ounce. Gold, I don't think 5,000 is out of the question. We'll see, but it's different than other commodities because, especially on the gold side, the gold just sits in the vaults. There's no real demand side of the equation where the gold's actually there's no real supply side question of the equation. Like, there's no supply disruption. If you add another 1 million ounces of gold production a year, it doesn't change anything. Like, all the gold's just sitting in vaults anyways. So some of the other commodities, like lithium's quite weak right now. I would say on the incentive price, you probably need $20,000. So that's double where we are today to make any of these projects work. Because right now they don't, especially in the North American context. Rare earths have been really strong. They're up about, most of them are, depends on which rare earth you're talking about. They're up 50 to 100% year to date. I think that's going to continue to trend higher as we move more into electrification and batteries, magnets and things like that. And then I guess graphite's another one for the battery metal. There's synthetic or there's natural. On the natural side, which is more related to mining, that's another one that in order to actually get new projects online, the incentive price needs to be a lot higher, and most of the world's graphite is coming from Mozambique and places like that in China that aren't the best environmental stewards and have a lot of challenges. But there are some projects that are trying to get off the ground in Canada here as well. But we'll need higher prices on that.
Okay, let's move to Ian. You've been quiet over there for the past couple of questions. So thoughts?
Yeah, I mean,
Commodities pricing.
there are structural and cyclical factors, right? So geopolitical uncertainties, again, persistent tensions, whether they're trade disputes or conflicts on supply chain vulnerabilities, they can create a baseline demand for safe haven assets that doesn't just jump back when the underlying conditions change. Those short-term rallies on the spikes in inflation data or on geopolitical flashpoints, they trigger those rapid inflows that they might normalize when the situation stabilizes. So you end up getting used to the higher price. That's one factor among many. And then there's also, I guess, the talk of the debasement trade, and it's not just gold that's being bought; it's Bitcoin and equities. It's a bunch of other sort of inflationary guards that are rising. And then, if I could, just from a risk management perspective, some key sort of themes to put in your heads around what you might be able to do to mitigate those swings. And at the risk of overusing the word, it's resilience. And it's having the flexibility to withstand commodity swings and supply chain shifts, and that takes an upfront investment in some of the things that we've already talked about, whether it's proactive geopolitical monitoring or scenario planning or mapping supply chain vulnerabilities. The underlying rationale there being that you can't anticipate what the market's going to do. You can't control the market, but you can control your readiness to move decisively when conditions change.
Thank you, Ian. And Gary, what are your thoughts?
So this is, in my humble opinion, is one of the greatest weaknesses on the global minerals front is pricing. Particularly when, again, you're boiling yourself down to essentially a sole source supplier around the world. They can set the price, and it can be as flexible today as a heartbeat. Goes away. Just again, the rare earths crisis of 2009, 10, and 11, I called it the season of the heartbeat pricing. You guys are already getting what I'm saying. That in a short period of time, you were seeing things start go, and then they went skyrocketing through the roof, and everybody panicked, screaming, bloody murder, the sky is falling. And then just as quickly, the price plummeted to below levels that no one in a capitalist or in a capital-based economy could afford to build. And that's what this kind of exposure has created, is such a fragility. So myself, particularly in my times working through the Obama, Trump one, and the Biden administration, was trying to tell policymakers of just how unreliable pricing data is in this space right now, because you do not have basic economics in any way driving the sector. It goes back to the earlier statement, Joe, that I think this bears tying back into, which was the whole issue about fast-tracking the projects, right? Because what is the finance community looking for? They're looking for the right market signals that's going to demonstrate that this is a legitimate issue that companies, governments, and all players in the field are going to stick to. It goes back to the resilience issue. Like, you're not going to back off this time because there's too much at stake. What does the old adage go? Those who do not learn from the past are what?
We're doomed to fail.
Doomed to repeat it. And that's exactly what we're looking at, is repeating the mistakes that were around back there. And then you go back to the new money in the market. What is that being driven by? The fast track projects that are setting the right kind of market signals. It feeds into additional projects, and this leads into a better quality of pricing mechanism, which we simply do not have now. And that's one of the things I think, if anybody out there who's listening to this, if you want to come be an entrepreneur and come up with something brand new, work with folks like the LME and other bodies around the world to come up with a source of pricing that shows a two-tier, frankly, China and everybody else, because that's what you're going to need. And seriously, if you're going to be trying to base your pricing off the Chinese pricing, good luck with that. Let me know how that works out. And
Yeah.
the answer is, doesn't work out too well at all.
Yeah.
So there has to be an establishment of two-tier pricing that shows the differences in the kind of manufacturing, because everybody knows that labor, environment, ESG, all of these things have to feed into the rest of the world. Countries like China do not.
Excellent, Gary. Daniela, final thoughts on this?
I'm just going to make a plug for uranium.
Okay, go.
NextGen's raised almost $1 billion in the last week or so.
Yeah.
Yep.
Yeah, Mark. So I think the nuclear industry is going through a re-rate in that we are realizing that it has to be part of the energy transition and energy security solution. It's a commodity that's been where we've seen underinvestment, as we've seen in a lot of everything else, maybe not gold. And so I think that's on an interesting trajectory, and we've seen products like the Sprott Uranium Trust that has raised over $1 billion and bought physical, and we've seen Denison raise capital to buy physical. So I think that's an interesting commodity that
Okay.
we've got to keep an eye out.
All right. Okay, next subject. Let's move on to AI in mining and delivery resources. Where do you see it making the biggest impact and reshaping the market? Ian.
Yeah, topic near and dear to my heart. I think at its core, AI addresses two of the things that investors and logistics experts care most about, and that's risk and efficiency. It can support with reducing operational risk, and it can accelerate decision making. So three different spaces that we see an impact today. One, producers extracting more value safely. So things like predictive maintenance powered by AI and autonomous haulage systems, cutting labor risks, that sort of thing. Two, maybe a little more interesting and over the horizon is making explorers smarter. So smarter targeting, optimizing exploration by really rapidly analyzing geological data and identifying promising ore bodies. And then helping supply chains move faster as well. So using AI-driven analytics to help companies sort of forecast demand and commodity price trends and optimize their shipping routes. And we see the biggest gains in the next few years in that first topic, so the exploration, predictive maintenance, and some limited automation. And a little bit further down the line, sort of 5+ years, I think it's reasonable to foresee the widespread use of AI-driven exploration platforms and more autonomous fleets. And then the big sort of long-term prize for AI in mining is really low impact mining. So sometime in the next 10 years, one can foresee AI-enabled digital twinning of mines. So full real-time simulations to optimize operations and sustainability. And then there's sort of an ancillary point there to make around making the sector more attractive to the next generation. Because obviously,
Right.
there's a tech angle there, and being tech native, the younger
sure.
generation is going to respond.
For sure.
Yeah.
And I can say, at our conference, we sponsor 50 students from all across Canada, and we've had a big uptick in computer science students, and it's all about AI and how we can relate it to mining. And I'm gonna swing over to you, Daniela, because Ian finished off with the sort of the production side of things and how AI can impact or help that. So maybe you have some comments on that.
I'm excited because it gives us foresight, to your point. And so I think we're past the autonomous trucks and trains and so on, but into if you can accelerate modeling, if you can accelerate mine planning, if you can accelerate running different mine planning scenarios at different price decks, at different productivity rates, and so on, it will accelerate decision making. And in an industry where I'm going to suggest maybe decision making has been slow, because it does fill the time, because it takes 5, 10, 12 years to permit. It takes a year to get an exploration permit to drill X number of holes. So when we accelerate these other things, we will have to accelerate our decision making. So I'm excited about the foresight.
Excellent. And Mark, thoughts?
I'll go back to my technical roots, and I think Ian touched on this. Like, for me, what I find most exciting is on the exploration front. When you think about what you actually have to do to find a project and the amount of work that goes into it on the grounds, like from grassroots exploration to sticking tiny holes in the ground to try to define an ore body, I think the predictive modeling of AI, and we've seen big investments even before, all the ChatGPT stuff with Cobalt, and that's backed by Bill Gates and Jeff Bezos, like that sort of stuff. I get really excited about that. I think we need more projects to look at, especially on the copper side. Like, these projects are getting harder and harder to find. They're getting deeper. They're getting more expensive to just define them, and then certainly to build them. So I'm really excited what AI could bring to that. And it's kind of similar in a lot of ways to what you hear about in like the healthcare diagnostics and stuff like that, that predictive modeling feature, just so that we could all find more projects that are economic to advance.
Okay. Next question. Critical minerals, energy transition metals such as copper, uranium. What projects have been positively affected? What is the long-term effect? Gary.
Well, this is one I'm particularly very excited about, is to kind of see that really for the first time in a long time that things that have been classified subjectively, not objectively, as critical minerals. And I don't mean that to dismiss any of the work that's being done globally, but critical minerals themselves, that is a definition of a subjective nature. It's not an objective criteria that is used other than the modeling that the U.S. Geological Survey does. And so what I was especially, and I think a lot of people were excited about, was seeing that the Trump administration made decisions that it was going to be branching out from a traditional critical minerals model, and was looking at items that, for even though the data itself may not give you the threshold number you were looking for, which is how USGS does its modeling, that there were many items such as copper that have an extensive exposure across many landscapes, not just in the energy transition, but in healthcare and numerous areas as well. So I think that is a very exciting development that really bears monitoring going forward. And really, I'm excited to see how there's going to be looking at other areas, including rare earth and some of the other, what we call critical mineral byproducts. I don't call them the kinds of materials that get all of the attention, but you have co-products from mining processes like gallium and germanium that are so essential to so many of these applications, and should be getting the full attention that others do, even though you don't mine a gallium or germanium, but they are an essential co-product that needs to be getting the kind of attention going forward. That's something that is definitely worth looking to the future. And then it's starting to really look at what does the energy transition of the future look like. For many people, they could kind of see the Trump administration's focus on this particular issue, because if you look at, particularly in the United States, during transition, you look at the first dozen executive orders. Why? Because that is your predictor of the priorities of that administration. And one of the first ones that the Trump administration, Trump himself, signed was what? Energy transition. And this idea that this was going to be taking an expansive approach, looking at things that where the four-letter word coal was now being revisited. Uranium and nuclear energy was going to be a consideration. That is something for everyone that should be seen as a positive sign, because it basically is saying that energy is available in multiple thresholds, in multiple sources, and that should be embraced. Because what do you want? Just like supply chains, you want what? You want diversification. What does that build? Resilience. What does that reduce? Volatility.
Excellent. Mark, thoughts on that?
Well, when we were kind of prepping for this a few weeks
Yes.
ago, there's been a few announcements since then
Yes.
and there's been a couple meme stocks here that have just broken out. So Lithium Americas, obviously the US government just took a stake in that one that got mentioned earlier, Trilogy as well. And these stocks are up like 300%. So it'll be nice to see those things getting advanced. I think there are a number of announcements to come. I would say the G7, the environmental ministers are actually here in Toronto in, I think, 3 weeks' time at the end of the month. I'm hearing a lot of chatter. There's going to be a big announcement coming out of that, with potentially multiple governments working together. So I think there's going to be a lot more to see on that, with other projects. So we'll see if the meme stocks continue, but it's good to see. And these guys are going to be able to fund these things and move them forward.
Excellent. Ian, any quick thoughts before we move on to the final question?
Yeah, very quickly, maybe. So critical minerals are the backbone of the energy transition, obviously. So wind, solar, grid storage, hydrogen tech, and the same sort of supply chain challenge apply to all of those sectors, and that's China. And we've touched on China. We talked about China, but it's worth sort of underscoring just how dominant they are, sort of across the full suite, upstream raw material processing. They control large portions of midstream refining and chemical processing, and so replicating that scale in a North American context, I think it's not a short-term endeavor. It's a decades-long challenge, and I think we're beginning to wrap our heads around what that's going to involve. Everything from JVs and targeted government support to real strategic partnerships across the board outside North America with supplier countries as well. But infrastructure, regulatory timelines, they've got to keep pace, and that's sort of an open question as to whether they will.
Excellent. Okay.
Hey, Joe,
Yes.
if I could go back to Mark's comment about the
Yes.
G7 event that's upcoming. Many folks may know that there was a G7 event in Chicago at Argonne National Laboratory in September. And the word coming out of that was that there is this idea now of a more cooperative relationship among the G7 plus some other countries that's beyond just the G7, because
Right.
India's been involved, and so is Brazil, and so is Australia. That, to me, has potential that is historical. Why? Because it brings together the three things that you need to have. One, which is a large international support. Secondly, those that are in a producing capacity, those that have the ability to extract and to produce. And then thirdly, those that are involved in downstream consumption. That's what you need to truly set the stage for the future of this sector. You need global partnerships, you need global relationships, and you need those that are involved in extraction and those that are involved in processing, because it comes from raw material all the way to the OEMs, and having those kinds of relationships is going to be one of the keys to the future. So Mark, I appreciate you bringing that up, and I commend that, because I really think that's a great thing to see happening.
Yeah, it's going to be very exciting, I think. All right. So we are now at the last question of the evening, and we're going to end with a subject that's near and dear to Daniela's heart, ESG, leadership through mining. What are the major changes in our industry, both positive and negative? Daniela.
I don't think that there are changes in our industry per se. We've always had to operate our businesses in a sustainable manner. We go where the asset is, and so often you have companies that operate around the world that might be based in Toronto, might be based in Vancouver, and so the necessity to earn the license to operate in those countries and those communities has always been there. We've seen a recent pullback in global reporting requirements, or the road that the regulators were on, the SEC, the European regulator, and even in Canada, in implementing and possibly unifying reporting requirements and making that part of continuous disclosure rather than a sustainability report that we issue every year. And we've seen a pullback in that. We've seen that in Canada as well, with the view from the CSA that they wish to remain competitive in the global capital markets, and therefore not really moving forward in progressing or accelerating those global reporting requirements. But at the end of the day, just because we don't have to report globally in a more stringent manner than we thought we may have to this year, next year, we still operate globally, so we still have to care for the water, we still have to engage with communities, we still have to do all the things that we were doing in order to operate where we operate. So I'm going to say,
to be a good
change
corporate
in
citizen,
in global
reporting.
regulatory reporting, but not really a change in
Much.
how we run our businesses.
Yeah. And Gary?
Well, this is one that's very near and dear to my heart, because in both of the last two administrations that I worked with, there was a real emphasis for the need to do ESG beyond just a soundbite. But messaging sometimes is the key, and sometimes that's what I think is missing here. There has been a lot of public engagement in the issue, but follow-up and intentionality has been disappointing. And that is from companies that I've spoken to, not just in the United States and Canada, but in other places as well. So one of the things I think a real positive would be is making sure that these kinds of conversations turn into actual corporate policy. But let's always also be honest that at the end of the supply chain, the OEMs and those that are buying, they're profit driven. And so it goes back to the two-tier pricing system. There may need to be some very difficult decisions made in the future on whether or not we're going to get serious about ESG beyond just a soundbite or a talking point, but you're actually willing to have downstream consumers more active in the actual purchasing of these products. Because if not, we'll be looking at a decade or 25 years from now and not seeing the progress, because whether it's local indigenous communities or those that are just actually in the early stages of trying to do things the right way, whether it's through tracing or whatever it might be, are going to get run over or overlooked entirely. And that's one of the things I do not believe, as those of us who are stewards, because I think people will understand what a steward is. You don't own it. You're actually just a part of the transitioning of that material into another material. It's all about good stewardship, both in the environment, but also with the labor.
And I would say, particularly for mining companies that operate all over the world, we need to make it part of our culture.
Absolutely.
Whether we're whether we're writing a report on it or not, it needs to be part of our culture going forward.
Great.
Because, there's nothing worse than problems with your tailings dam in a foreign country. So,
But there's also the positive side, Joe, like there's nothing better than engaging with, say, the indigenous communities or First Nations or whatever, and laying out the benefits to them long-term that could actually make a huge positive, multi-generational positive impact on their future, on their economics, on their quality of life, on so many other things if it's done the right way.
right.
I'm going to suggest that it is being done, because otherwise you're not gonna have that permit. You're not gonna have that mine.
Absolutely.
And so, can more be done? Absolutely. There can always be more. There can always be better communication. There can always be different structures. But I think we've come a long way.
For sure, but there's still too many good projects that are being held up like we've seen in the States, we've seen it here in Canada, where projects are being held up for years and years and years because they're being litigated and they're being fought out in the courts, and nobody wins except the lawyers when these things end up in courts.
It's like divorce.
What's that?
It's like divorce. The only ones winning are the lawyers. I get it. All right. That is well said, Gary and Daniela. And that wraps up the panel. That's it. All right. Well, once again, I would like to thank our panel this evening for a fantastic evening and a fantastic conversation with everyone. I think this was, it's the first time I've ever moderated a panel. So thank you for going easy on me, guys. I really appreciate it. Thank you to our fantastic audience for joining us this evening. We really appreciate your attendance. There are some drinks and libations and refreshments for you at the end. If you have any other questions, the panelists will be around for a bit. So please feel free to ask them any questions you would like. And thank you once again to our fantastic sponsors, TD, Mercury, Vid, and Marsh McLennan, for allowing us to have this fantastic discussion tonight. Thank you very much.